Hello and welcome to the In Focus podcast. I'm Devyanshi from the Hindu's data team. Today, we're talking about something that affects millions of Indian households: how and where we put our savings. For decades, most families trusted fixed deposit, insurance policies, and gold, and a large faction still continues to do that. But in the last few years, there has been a notable shift. More and more Indians are opening demat accounts, investing in mutual funds, and signing up for something called a systematic investment plan, commonly known as SIPs. At the same time, foreign investors have been pulling money out from Indian stock markets. Yet, the markets remain more or less steady. Is it because domestic investors are stepping in? And can this make us less dependent on foreign capital in the future? To help us answer these questions, we are joined by Ankit Mandholia, the head of equities, derivatives, and wealth management at Motilal Oswal. He will explain what these trends mean for investors and the markets. Thank you so much for joining us, sir.
Thank you. Thank you, Devyanshi. Very happy to be here.
To begin with, in the last few years, we keep hearing that foreign investors are leaving Indian markets, but the markets are still stable, right? So, can you explain in simple terms how much role do domestic investors play in keeping the market stable, since there's a steady year-on-year increase in the share in the capital market?
That's quite correct, Devyanshi. So, FPIs or foreign portfolio investors have been one of the more important investor categories over the last 2 decades in India.
Right.
However, if you see the more recent past, that is especially over the last 1 year, FPIs have been persistently net sellers. For example, they have pulled out almost $2.7 billion in September alone. And, this has taken our YTD outflows to one of the highest on record and on a yearly basis.
Hmm.
Now, previously, when these kind of high numbers of outflows used to happen in the Indian markets, our markets used to correct quite a bit in this kind of pressure, and the prices would see quite a negative trend. However, with such high numbers of outflow in this last 1 year, our indices have held up far better. And what has been one of the most significant contributor is the domestic money, which has turned out to be very structural in the form of the equity SIP flows on a monthly basis. And we have seen now that the SIP flows have been positive for over 50 plus months. Like post COVID, it's always been positive and has been rising.
Right.
In fact, it has increased up to 28,000 crores a month with almost 9 crore SIP accounts. So this steady rule-based domestic flow of money has really helped to offset the hot money swings and has made India less hostage to the global risk cycles.
So, like you mentioned, SIPs have seen a incredible surge. So, can you explain why have SIPs become so popular among ordinary Indians?
There are quite a few reasons why SIPs have become so popular with the Indian uh, households. And in fact, like if I have to marry everything together, it's like it resonates very closely with our Indian way of thinking of saving, and it links very closely to our salaried way of living. Where a small debits are done, but with those small debits, a very big discipline is achieved, and it makes extremely better odds. Because now what you're doing is because you're regularly investing, um, your odds of success or odds of buying something at a very high price or things like that reduce quite dramatically. It's a product which is very well suited to the Indian mindset. So the behavioral fit is a very important component for the popularity of SIPs.
Hmm.
Automated monthly debits happen, and this removes the anxiety and it builds discipline. It also helps in a good financial planning. Number two is the entire SIP investment way is completely digital, and most of the people find it extremely simple, and the cost of investing is also very low. Now, because it's digital, it happens on a particular time, the timing is fixed, it happens at incredibly low cost. So what the customer gets in terms of the value of investment is also very good. We have a number of distributors, number of apps, number of ecosystems. All of this makes it fairly simple. And I mean, even a 1,000 rupees SIP, 2,000 rupees SIP, 5,000 rupees SIP is something which is very easily executable. Uh, a third thing which has contributed to the SIP's popularity in India is the trust factor and the outcomes, the overall performance. Uh, all the Amphi data, it points out to that the SIP book is becoming large month on month. This money tends to be sticky, so people have the confidence. And most independent analysis are showing that the last 7 year returns for SIP, last 7 years return for SIP have delivered a very decent double digit XIRR across categories, across AMCs. Now, this kind of a return and stability has reinforced the word of mouth. It has reinforced the confidence of the people. And, you know, the whole product becomes a very good fit from a Indian behavioral point of view.
Right. Can you also explain how does investing in small amounts regularly help the stock market?
SIPs turn volatility into inventory. What that means is that investors average cost while markets make gain steady oxygen. So let me explain this. So for households, SIPs or systematic investment plan, they spread the entry points on a rupee cost averaging method. It reduces your timing mistakes
Okay.
and it compounds over long term. Over the last 7 years, we look at a very simple SIP plan. The XIR returns have been quite strong double digit. The reason for that is the rupee cost averaging. When the markets were low, you were investing the same amount of money and were getting higher number of units. When the markets were higher, you were investing the same amount and were getting the lower number of units. So your overall costing on the number of units becomes very decent. Number two, it brings discipline and removes the mistake of that, oh, I have to buy it at the bottom and I have to sell it at the top. You have most of the people, they set either the first of the month, the fifth of the month, the 10th of the month, the end of the month, depending on whichever way they feel comfortable, and they're ready that okay, this much amount will go towards it.
Right.
Many people also did regular investments also help them in one very important thing, and that was achieving certain life goals. People had SIPs created for buying a car, buying a house. Students did it for study abroad. Families did it for foreign travel purposes. People have done it for retirement purposes. So this kind of a regular systematic investment with a rupee cost averaging and a goal-oriented solution made it a very good way for regular investors and markets and a very viable asset class for investments.
Right. Sir, if foreign investors pull out, should everyday Indians worry about their money in the mutual funds?
So this is what I say now. FPIs trade India, but Indians now own India. So SIPs have become our market's shock absorber. And I think it has really taken everyone with a very strong amount of conviction and a very positive surprise that how sticky this money is and how consistent this money is. So while FPIs can maybe shake prices, maybe they can have a little bit of small term impacts and everything. I don't think that the impact that we used to see with FPIs earlier withdrawing out of India would be the same given such a huge shock absorber is there. Um, so my short answer is if you are hearing that FIIs are exiting India or they're pulling out money, just don't panic.
Right.
The portfolios that you are investing in are very diversified. Uh, funds flow ins happen day in and day out, and domestic SIP flow is very cushioning. It's a very sticky money. It's a money which is there for the long term. It's there for the longer horizon. Some enemies might come up and down, but the right thing is to continue to remain invested, continue with that discipline, and focus on your time horizons. FPI headlines are extremely short term, and it's very much proven now that even with FPI outflows, domestic buying provides a very strong support and cushioning to the market.
Since now that mutual funds are becoming a fast vehicle for investment, would it be right to say that the increase in number of demat accounts is an influential factor in shaping people's willingness to invest in mutual funds? What I mean to say is that by giving people access to demat accounts in itself is a good motivator to invest. Can you elaborate on this and as to what explains the shift in behavior more?
Eventually, the mutual fund investment um, is a very good way for a long term saving and for a disciplined saving. However, when you want to make wealth,
Hmm.
demat account is one of the most essential things. Demat account enables a person to invest in equities directly, pick stocks of their own liking, uh, strategically invest in certain sectors that they feel is better, increase allocation to a particular stock, increase allocation to a particular sector, play more tactical games, and it really helps in a long term wealth creation.
Hmm.
Over the years, a lesser number of Indians have been investing in direct equity. And given now that mutual funds flows have shown to the people that returns on equity can be stable and more structural,
Right.
more people have opened demat accounts in order to directly invest into equities.
Hmm.
The basic rule of thumb that I follow and I advise to most of the customers is there is no one right asset. You need a little bit of both. First, you definitely need to build a very strong, basic long term investment plan, which you can do through a systematic investment plan through a SIP, and you start working towards your goals. But slowly and steadily, once you have built on those two savings and you want to now go from savings to wealth creation,
Hmm.
that's where you need to start diversifying yourself and also investing directly into equities. Direct equity investments are still relatively underpenetrated in India, and this really shows that there is a lot of potential. I believe that we are now up to somewhere close to 12 crore demat accounts, and
Yeah.
there is no reason why this number cannot be 15 crores, 20 crores, or 25 crore demat accounts. So we are clearly in that trajectory, and the information, the data, the easy onboarding, the easy apps, the new number of IPOs that are coming, the success of mutual funds, the success of SIPs, the overall confidence that people are now having with equity as an asset class. I believe that demat accounts growth is here to stay, and in fact is has a very good headroom to even increase from here.
Right. Like you mentioned, India went from around under 4 crore demat accounts to nearly 12 crore in just 4 years of time span. And we see participation from smaller towns is also increasing. In 2015, over 90% of mutual fund asset under management came from top 30 cities. By March 2025, this had dropped to less than 70%. While the share of smaller towns and overseas investors rose to 30%. Um, does this mean more people from tier 2 and tier 3 are becoming risk takers?
Absolutely. Though I would kind of rephrase it, I think penetration outside metros is the big story. Uh, Equities are definitely a more risky asset compared to fixed deposits, but uh, I don't think that a person who's investing in mutual funds or in equity markets is necessarily taking a complete risk. Mutual funds by themselves are diversified, they and for a medium to long term investment will provide better value proposition and better returns to the customer. What is happening is Indians or the general Bharat is now moving from a fixed mindset to a flexi mindset, and from a only deposit based mindset to a more goal based mindset to a more aspirational mindset. These are the signs that happen with any aspirational country, with any fast growing country. Um, we can look at any nation which has been on the trajectory of wealth creation. Wealth is created through equity. Wealth is created by investing in companies. Wealth is created by investing in the economy. And whether it is invested in through the ways of mutual fund, through the main means of direct equity, uh, it does not matter as long as there is a correct exposure taken to equity in your overall savings and investment plan. Coming back to your question about the rise in small town investments and investments outside metros, I think that's a very, very heartening sign. Um, tr- that's where the real Bharat lies. That's where the real growth of the country lies. It is very encouraging to see that people are trusting the growth stories of India. They are supporting the entrepreneurs of India. They are providing the capital which is needed for this country to growth. So I think that trajectory is there
Right.
and it's going to continue. And the wider the participation that we see outside the metro cities, the more better it is for the overall equity inflows.
So, is this shift in general good for households? What would be your final thoughts?
Largely, yes, if done right. I think for our households, this shift will help you beat inflation, it will build retirement wealth, and it will diversify risks while keeping everything as compared to keeping everything in fixed deposits, gold, and real estate.
Mm.
For the economy, I believe it channels savings into very productive capital. It lowers the cost of equity and it supports India's capex cycle.
Mm.
The caveat that I will leave with the people is that the participation must be informed. There needs to be a right asset mix. You need to still own adequate insurance, emergency funds, and you need to be aware of the risks that come generally with the investments into equities.
Right.
India still has somewhere around 10% of households participating in markets. So there is a huge headroom for growth. The runway is very long. And the policy advice and investor education is helping us channelize this in a very structured way. So my overall take is that the more equity in savings means that there is more equity in growth
Mm.
and households will prosper as India's capex flywheel keeps turning.
Right. All right, sir. Thank you so much for your insight. It's been a valuable conversation in every sense. And that's all for this episode of In Focus. Thank you all for listening.